Looking to take your financial knowledge to the next level? You're in the right place. Welcome to Ask Ralph, offering accounting, technical, and financial advice. Whether you're looking to save taxes or improve your business, he's got you covered. Here's your host of Ask Ralph, Ralph Eastup Jr.
Welcome back to the Ask Ralph Show. I, for one, am really happy that the tax filing deadline is over, so it gives us an opportunity to talk about some other things that we've been putting off while we've been spending so much time dealing with taxes. But I thought I'd just start off this after tax season show with a little bit of more tax issues, and that is how to do your taxes so you don't end up owing the government at tax time. And I thought this was really an interesting thing to talk about now, because I would bet that a lot of people are getting over the shock of having to pay the IRS, back on April the 17th. And there are certainly some ways to avoid that. One of the things that I see affecting a lot of people is income from self-employment. Sometimes you might call that, a side job or some sort of, off the books income. It's not W-2 related, not something you're working for an employer. And I've seen in my practice, this is where most people, get themselves in trouble and end up owing money at tax time. So there are definitely some ways to avoid that. And with it, just being right off of tax season is a great time to get started on planning for this for the future. There's an article that was written by a fellow by the name of Josh Furling, and it was posted on April 3rd, 2018 on the CSNBC website. And one of the things he talks about here is that he was a freelance person, and the first time he did his taxes being a freelancer, he ended up owing $1,600 to the IRS, and he made a vow that he wouldn't allow that to happen again. And I will tell you from personal experience with my clients, this is something that happens quite a bit. People go into business thinking, I'm going to work for myself, and it's going to be a fantastic thing. Then they come in and get their taxes done, and it's a bit of a nightmare for them. So, and one of the things he mentions here, and I think this is kind of funny, he says, I've heard horrible advice from some CPAs advising new freelance workers, like, don't worry about estimated tax payments because you can earn more money by investing in them. Well, that is somewhat true, but not always true. And one of the things they say here is human beings are awful at accounting for lump sum costs and do much better if you pay a little at a time. So let's talk about this from a behavioral finance perspective. And I think this is really good advice, and that is the pay-as-you-go model. And a lot of my clients will say to me, hey, Ralph, as I'm making money doing this freelance work or side work or whatever you want to call it, one of the things you're supposed to be doing, and I stress supposed to be because the IRS, basically requires you to pay tax over the course of the year as you earn money. Just like when you're working for someone else, your employer, whenever you get your paycheck, they're withholding, federal, state, Social Security, and Medicare taxes from your pay. Well, you're supposed to be doing the same thing if you're doing one of these, side businesses or, self-employment income. Now, the IRS gives you a fancy form called a 1040-ES to figure this out. But to be honest with you, it's not as simple as it may seem. It's not as simple as saying, well, I'm going to make, $10,000 this year, so I'm going to owe, $2,500 in tax, and let's take that number, divide by 4. And what I will say here is this is a good time to consult with someone who is a professional, an accountant or, a financial advisor that can sit down and go with a way to do this. And one of the things they mentioned in this article, and I have to say I'm a big proponent of this, is creating a schedule where you basically become your own payroll department. And this is a pretty cool way of looking at it. And what this fellow does, and I think is a very good idea, it's a flexible system that manages the problem of putting money aside. And for me, what he says is this is a separate savings account, which he particularly uses as credit union. It could be as simple as a cash, you stick in your sock drawer. The important thing, it needs to be, at least psychologically separate. So what this person's advising to do, and I really like this idea, is whenever you get any freelance income, immediately put a set percentage of it into your special tax account, which I think is a great idea. And the reason that is, it's the money you owe the government as soon as you earn the income. It's your money right now, but the IRS you're going to owe them at the end of the year. And then as you put aside this money, you'll 4 times a year send however much you've accumulated in your special account to the IRS. And I think this is a great idea because then, basically you can look at it like this. Let's say you're doing freelance work where maybe you're doing, landscaping work. And let's say you take on a job with Mrs. Jones down the road. And Mrs. Jones, she needs all of her trees pruned and she needs new mulch put in her beds and she wants you to, fix up some little odds and ends. Let's say the job is $1,000 job. Well, according to this approach, then you would come up with a percentage of what you're going to put aside for taxes on that $1,000 job. So when you collect that payment, from Mrs. Jones, you'd set that money aside. Now, therein lies the big question. What is the hard number that we're going to use for estimating our taxes? And this is where it gets into a discussion they mention here is there's no one size fits all figure. And what they mention here in this article, if it's more than $100,000 a year, you should be consulting with a tax professional. I think it's actually, if it's more than about $20,000 a year, you should be consulting with a tax professional. And the reason I say that, and I've talked about this in other shows, is there are things that you can do to help mitigate the tax cost of this, not to mention some liability exposure you have. And I'm not going to get into a big, long discussion about liability because I am not an attorney. But I will say this, there are things that you can do. So one of the things that I would recommend is, figuring out what your, marginal tax rate is. And that's a fancy way of saying, what is the maximum amount of tax you're going to pay? Now, when you're working for yourself, a lot of people forget about this part. And there's not only the federal and state tax, but there's a scary thing called self-employment tax. And self-employment tax is the Social Security and Medicare tax that you're paying, on your own wages. When you work for someone else, your employer is paying half of your Social Security and Medicare, and you're paying the other half. So what I generally tell clients is, for example, let's say that, as a family, you're in the 15% tax bracket. Well, then clearly you're going to want to save at least 15% of whatever your freelance work is in your tax account. But now don't overlook the fact that you've got to be concerned about that self-employment tax as well. And that self-employment tax is, 15.8%. Now, it's not quite 15.8% because you get a little bit of a benefit on the front side of the 1040 for a deduction. And then with the new tax code, there's a 20% reduction in income to hope, to level the playing field here. But that's got a lot of complications to it. So generally what I tell people is, if you want to put away about 20% for federal tax and then 5% for state, which makes it pretty simple. So if you put aside 25%, then, on every job you do, literally just pay. One of the things I've heard people say, pay yourself first. Well, when you collect that money from Mrs. Jones, you take that first 25% and you put it in a separate account that you do not touch. And then 4 times a year, you send it to the IRS so that you don't get yourself in a jam when it comes to tax time. And then, and we can get into a whole discussion with this, and then put another 5% in for the state. So it's also 25% overall. Now, all of this is intended to avoid paying any penalties. And I'm not going to spend a lot of time talking about this, but there is a safe harbor rule, which basically says that if you look at your previous year tax return and you pay at least 100% of the prior year's tax owed, you won't pay any penalties. So that's why I think this approach is really good, because it takes that 25% of your tax. Now, if you have more income than that, then I think you need to sit down with somebody like myself and, let's make a plan of how to do this. But if it's a simple, a side business or something like that, I really feel like 25% would be a good way to do it. And with each job, put that money aside, and then quarterly take that money and send it to the IRS and to the state. I hope this has been helpful dealing with how not to owe the IRS at tax time.
You've been listening to Ask Ralph, brought to you by Saggio Accounting Plus. Please subscribe to and rate our podcast on Apple Podcasts or wherever you get your podcasts, and leave us a rating and review. Our podcast is produced by Carolyn Peters. Thank you for listening, and be sure to like us on Facebook and follow us on Twitter at Ask Ralph Media. You can also hear me each week on 1450 WILM and on 1410 WDOV in Delaware, and on the iHeartRadio app. Submit your questions or ideas for future shows by sending an email to AskRalph@AskRalph.com.
The information contained in this episode of Ask Ralph is based on data available as of the date of its release. Saggio Accounting Plus and Ask Ralph Media Inc. is under no obligation to update this content if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances, and any information provided is not to be considered as financial, tax, or legal advice. Please consult your tax advisor or attorney before acting on any material covered.